Do you want bigger investment returns? I love dividends and I love value, and this video will show you how to target both at once and boost your returns in a big way. We are talking about dividend yield theory. The results of using this theory in a model I will show you in a minute have beaten the S&P 500 on a 3, 5, 10, 15, 20, and 30-year basis. What is dividend yield theory? The theory is that large, high-quality companies which have stable earnings and business models and which have paid dividends for a long period of time can be valued by their dividend yield. If you don't know what a dividend yield is, take a look at the video linked at the top of the screen. Why do we want to buy companies when they are undervalued? Because that is how we lock in bigger returns and make more money. If you prefer to buy products at the store when they're on sale, I think you can appreciate buying investments for a discount as well. I think you can also appreciate all the hard work that goes into making these videos, so please give this video a like. It helps the YouTube algorithm get this video out to more people who are interested. Let's take a look at Pepsi on fast graphs to demonstrate why dividend yield theory makes sense. Most companies who pay a growing dividend tend to pay that dividend within a certain yield range. Pepsi's dividend yield has almost always been between 2.57% and 3.27% over the last 11 years. It spends most of its time between 2.6 and 2.9%. Anything outside of that range is out of the ordinary. As the company grows its earnings, it also grows its dividend. As the dividend and earnings grow, the share price also increases. Look at Pepsi's growth shown in dark green. Over the past 20 years, it has grown consistently. The white line is the dividend, which has grown with the earnings. If you look at the blue line, it is the average PE ratio. When we look at the blue line, we see that the price is following the earnings and dividend in a similar manner. So the dividend, the earnings, and the price to earnings are moving in tandem. However, if you look at the black line, that is the price to earnings. The price jumps all over the place because the markets are fickle and inefficient. Because the price jumps up and down as people irrationally buy and sell, the dividend yield also jumps up and down. The dividend yield is shown here in red. Sometimes the share price grows faster than the dividend did, like it did here. When this happens, the dividend yield will decrease as we see here. This typically means the company is now overvalued and the share price is likely to slow down or come back down in the future. Sure enough, that's exactly what happened. Between 2000 and 2004, Pepsi's annual rate of return was only 1.5%, including the dividend. When the dividend grows faster than the share price, or the price drops like it did here during the financial crisis in 2008, the yield rises and shows the company is undervalued. We can expect the share price will increase soon. That is the time we want to buy. Because over time, the dividend yield will return to the average range. We want to try and buy when the yield is high, which shows the company is undervalued. In the Holbert Financial Digest, this dividend yield theory was put to the test using an investment quality trends or IQT model. Take a look at the results. Using the dividend yield theory, better returns were achieved over every single time frame. While the differences may seem small, remember this is compounded and actually substantial. That seemingly tiny 1.01% improvement they got by using dividend yield theory for the 30-year span would give you an additional $54,617 if you had invested $10,000. How can we implement this ourselves? I'll show you. Take a look again at Pepsi. If you bought in 2000 when the yield was at its lowest at 1.12%, you would have made an average annual return of 6.5% until the present. What if you bought when the dividend yield was at its highest? Look at this high yield here of 3.11%. Buying at that time would have given you an 11.7% annual return. Let's look at the second dividend high yield point. Buying at the second high yield of 3.25% would have given us a 17.4% average annual return until the present. Compare that 11.7% and 17.4% to the 6.5%. If you'd invested $10,000 20 years ago with an annual return of 11.7%, you would now have $91,424. If your investment had instead compounded at 6.5%, you would only have $35,236. That's a massive $56,188 difference. Which would you prefer? We want to watch companies like Pepsi for when the yield spikes. The dividend yield as of April 7th, when I made this video, was at 2.93%. The spikes we were looking at were over 3%, which is preferable. Pepsi's average dividend yield over the last 5 years was 2.84%, which tells me it is a little undervalued relative to its usual price in dividend because 2.93 is higher than 2.84. Still, it is not the opportunity we saw previously with 3.11 and 3.25. However, if you had bought Pepsi a couple weeks ago on March 20th, 2020, the share price was $103.93. The dividend is $3.79 per share. 103.93 divided by 3.79 gives us a yield of 3.65%, which is excellent for Pepsi. The yield shows it was time to buy. Unsurprisingly, if you had, you would already be up approximately 27% only a few weeks later. What companies have you been looking at which look undervalued based on dividend yield theory? Leave a comment below and let us know. I hope this has helped you better understand dividend yield theory and how to use it to make impressive gains on your investments. As a final caution, make sure you are only buying high-quality companies with this strategy. Do not buy companies whose dividend yield has spiked because the company is financially unhealthy and is in serious trouble. Those are called dividend traps, and the 10 signs of a dividend trap you need to watch for are described in the video linked at the top of the screen. Thank you for watching, and please subscribe to my channel because I am creating new content for you every week.